Welcome to another edition of the March to a Million podcast with your host, Greg DuPont. I'm RJ Malik, producer of this podcast. And today, Greg, your guest is Taylor Vick from Blue Ridge Asset Management that specializes in real estate investment and investment consulting. So why don't you welcome Taylor and get this podcast started?
Well, thank you, RJ. Taylor, thanks for taking the time out of Juneteenth to be with me here today.
Glad to be here.
Yeah. and within all the other scheduled activities you had going on today. So thank you for taking some time out for this conversation. For some listeners that have been with us for a while, this is now Taylor's second trip to us. And I'd like to have Taylor come in and talk about what I believe is an underserved asset class in retirement. Yeah, very few investment advisors, financial advisors want to go into the waters that Taylor talks about. Why? Because, well, they don't make money off of it. But, our clients, Taylor, you've seen this a lot. I see it a lot. They're looking for different alternatives on how to build wealth. And friend, you represent the time-tested way of building wealth through leverage, and that is real estate.
Absolutely.
And so first, before, even though I imagine somebody might have listened to you before, but let's quickly, let's talk a little bit about who Taylor is and why I've got you on as my expert, because my friend, you are. So let's talk about a little bit of your trip, your experience in investing, and what got you to the point where now, this was not mentioned by RJ, but your role that you take now for many people as a fractional real estate manager. So let's talk a little bit about Taylor's journey, and then we're going to weave that into, individuals, how they might be able to take some steps into this to build wealth. And as you know, generational wealth comes through real estate. So Taylor, you've got a big chore today.
Sure. Glad to do it. And, as you mentioned, real estate is the time-tested investment. I think we all know what the oldest profession is, but the oldest investment has got to be real estate. Advisors in the industry these days have done a good job of labeling it as an alternative investment, which is kind of ironic thinking about how old real estate is, and that stocks really didn't come along in any fashion until 1602 with the Dutch East India Company. So real estate is much longer surviving than stocks, and in my opinion, not an alternative at all. So kind of my story with Blue Ridge and what I do. I started Blue Ridge 10 years ago. Before that, I was working in banking. I worked in banking for about 5 or 6 years. So we didn't have Juneteenth holiday back then, but we had things like Columbus Day. Those were very coveted, but now I work all those holidays. So things have changed a little. When I was in banking, I was also studying a lot for a charter called Chartered Financial Analyst, and learning a lot about investments and also learning about them through my work and trying to come up with a way that I could generate cash flow from investments. And when I looked at creating a portfolio of the traditional, what people call traditional investments, stocks and bonds, essentially, I realized I needed a heck of a lot of money to even get close to replacing what I was making then. And it seemed pretty much impossible. And for most people, that is a lifelong story. That's a 30, 40-year journey of investing in 401k or in stocks or whatever. So I started looking at things besides stocks and bonds. And the thing that was most appealing was real estate. At the time, I was pretty soon out of college, so I didn't have a lot of money. So I was able to borrow money to purchase real estate, which helped. I wanted monthly cash flow. Real estate can do that for you. I wanted some tax advantages on that cash flow. Real estate can do that as well. And I wanted something that will go up in value over time, which of course real estate does. And then with the leverage piece that you mentioned, you also have your tenants paying your mortgage off for you through their rent payments. So I heard someone say once, what's the best way to make $1 million in real estate? Borrow $1 million and have your tenants pay it off. So I got very interested into real estate then and started purchasing and acquiring real estate about 15 years ago. Then 10 years ago, I started Blue Ridge Asset Management. And for the first 5 or 6 years of Blue Ridge, we were almost exclusively putting together investment funds, the real estate investment funds. People may be familiar with REITs. This is a similar concept, but different legal structure. I did that for 5 or 6 years in multiple asset classes, primarily retail type investments in commercial apartment buildings and also single family homes. We had a portfolio about 125, 150 single family homes. And throughout the process of buying properties, investing in properties, I saw a lot of situations where there were people who needed help with real estate that they already owned. So the two big situations I saw were business owners who had companies that had real estate, both for the operations of the company, but also for their personal investment. And then I saw families who usually the father had acquired a lot of real estate and was getting older and wasn't able to keep up with it anymore. And the kids didn't want it. So it typically got kind of fire sailed. So there was no good tax planning. There was no value maximization. There was no continuity through the estate planning with the real estate. So seeing both owners of companies not being able to maximize the tax benefits and other benefits of their real estate, and then seeing families not being able to do that as well, I started doing consulting services under fractional director of real estate, where I come in and serve as a director of real estate for a family trust, a family office, or for a business to make sure they're maximizing all those benefits that real estate offers.
We've seen this in many cases. You and I have talked about together. That when we're getting into the estate planning conversation or the retirement conversation, people find themselves kind of at this spot where they've built a portfolio of real estate, and they recognize now we kind of got handcuffs. We've taken all the benefits of the depreciation and all that, and now how the heck do we move forward on them?
Yeah.
And that's where your team can come in to help provide some guidance. But let's take a step back in time, if you will, again with your journey, to the extent that you can share this. I've talked. I don't get the impression from any of our conversations that anybody ever flew in and gave you a pot of money to do what you have done. And you are a modest guy. I don't want to put you on the spot that way, but how did that progression go for you? Because I think this is a lesson that other people that are inclined can take from, and you don't have to go spend a lot of money at a weekend seminar for how to buy and sell houses. But did you get in it from the renovating and flip? Did you get in it from the buy and hold for apartments, or both? How did you walk into it? And when did you move from 1 or 2 units to 10 to 20? How did that work?
Sure. Yeah, I'll give you kind of my personal story, and then I'm very involved with my alma mater, Clemson University. I was a finance professor there for a while, and then I also talk to the students a lot. So I'll kind of go through what I give them of, hey, this is how you actually get involved today. So with my story, the first thing I did was purchase a townhouse in Charlotte for myself and my wife, who were engaged at the time, getting married. And that was pretty easy to get into without a lot of money, because a lot of times with the what we call owner occupied loans, or that means, hey, I'm buying the house that I'm living in, it's my personal residence. Those kind of loans have really high lending rates or high leverage. So I was working at the bank at the time, so I got all of the best terms and things. But these are terms that are available to really everyone. But in this case, I think it was like a $500 down loan. So it's like it's like going to buy a Kia, like 500 down delivers. So that made it very easy to get into it. But when I was purchasing that, I was looking at a lot of different things, especially where the city, Charlotte's a pretty big city, pretty wealthy city, to where the city and the county were spending money. So I looked at their 10-year plan, and I bought something near where they're doing all these projects. So they were building a new baseball stadium. It was near the existing football stadium. They were doing a new transit place. So I was buying something where I knew the property value was likely to appreciate because of all the infrastructure investment going on. And then I rented to a roommate. So when my wife and I were first married, we had a roommate, and it was nice because, at the end of the month, you had an extra, few $100 or whatever that you wouldn't have had otherwise. So that was the first real estate asset I purchased that I, made money off of through renting. The other thing I looked at when I bought it was, hey, if I move, can I keep this and rent it? And that is a property I still own today. I think I've had it 15 or 16 years. So that was really my first real estate investment. And it's something that is still cash flowing, still appreciating in value today. After that, I talked to a friend who had done some real estate investing and got his advice. And he said, first thing you should do is talk to family members. You may have some family members that have real estate. And sure enough, I did. My grandmother had a duplex, which is like a house that's split in two. So it's kind of like a 2-unit apartment, a duplex. And she didn't want to deal with it anymore and wanted to sell it. So she gave me seller financing, which basically means I paid her a mortgage payment every month and put some money down for that. And sounds like a sweetheart deal from grandma. And I'm not saying it wasn't. But I guess my point is there's a lot of people who will give you seller financing, especially if you know how to ask for it and how to explain it to them. So for the seller, they don't have to deal with the tenants anymore, but they still get a monthly check. The taxes from the gain of the property value is spread out over the period of the loan.
I want to underscore that because, many of the people that I work with, again, we're talking about in the estate planning arena, people listen to this program, what you just described is almost a get out of jail free card for a family with regard to, mom and dad need a little extra cash flow. And we always counsel away from just gifting the real estate. But what you just described there is a process where somebody in the family, maybe it's kids, maybe it's cousins or whatever, may look at that as an opportunity, and the family looks at it as an opportunity to say, hey, I can turn this into cash flow to help my current income needs. And we can do the details about who gets it all in the end. That's another story altogether.
Right.
But all that can be worked out within the context of an estate plan. And so that's kind of what you did with your grandmother as your next big jumping point.
That's right. Yep. She needed regular income. She couldn't keep up with the rental property anymore. And so I was able to provide her that regular income through the mortgage payment, and the taxes for the value increase from when she bought it versus when she sold it to me were spread out over the payment terms. So it was both a source of cash flow for her and a tax deferral tool.
And if I'm tracking correctly, my memory is a little vague because 15 years ago was when I just got out of having my title agency, and part of that was because of all the changes on the rise. So when you did that was after all the regulations came in, and it wasn't really during the free money era that was there 5 years before that. So I believe that the interest rates back then were not that far off of where they are now.
They were a little lower than now, but not as low as they were at the bottom. So, towards the bottom, we were borrowing money sometimes sub 3%, even on investment properties. Now we're high fives. So back then we were kind of around 4 or 4.5.
When did you make the move into putting these into corporate structure, LLCs, or however you structured it yourself? When did you make that evolution?
Sure. So that was about 2 or 3 years after I purchased that duplex. So after that, I did purchase, lots of other similar properties, a lot of duplexes. And then, about a couple years after I started doing that is when I put together the first investment fund.
So when you started putting them into the structure, when were you first able to use the structure itself as a financing vehicle as opposed to Taylor's? Well, you still may have put personal guarantee on it, but how did that work for you? When did you first get into that level of growth?
Yeah, that was 2016. So 10 years ago, which is when Blue Ridge started. So when Blue Ridge started, that's what we were doing for those investment funds. And that was pretty much running the entire investment process for different real estate assets. So we identify kind of an overall strategy that we thought would be successful, uh, purchase the initial few assets with our own money, and say, hey, we've got these two or three strip centers. We're going to put those into this fund, and we're going to buy 20 more or whatever the number is, and that's what we would go to investors with to raise the additional capital.
So you were going to non-traditional investors for the capital as opposed to going to banks for that? How'd that look?
Yeah, so it's a combination. So we were going to individuals, so we didn't take any capital from institutions. We borrowed money from institutions, mostly banks, but also insurance companies and things like that. And so we had, high net worth individual who wanted to get exposure to real estate. So they would invest with us. They'd have a diversified portfolio. We would run everything. With those, we did monthly distribution. So they got a check every month and they didn't have to deal with the real estate. Still got the advantages of principal pay down, depreciation, some of the tax benefits, while getting that monthly check.
So if I'm tracking correctly, you were building your own portfolio and steadily growing it, adding to it by personal credit and leverage and cash flow from each one of them. And then you took a fork in the road and you what I'll call professionalized it by thinking, okay, I'm going to take us to the next step and look to bringing in institutional investors, making funds that are available to other people. Am I tracking that first? Am I tracking that correctly?
That's right. You got it.
And so when you took that fork in the road, about how many properties did you have at that point in time?
So on the personal side, I don't remember the exact number, maybe 5 or 6.
Okay, so you're starting to really you had a good foundation, but all the supercharge has come after that. And at that point in time, at that 5 or 6, um, each one of those was on your own personal credit and all that. And how many doors did you have around? You had 5 buildings, but how many doors?
Yeah, at that point, maybe 10, something to that effect.
And did you have those in each of them in different LLCs, or did you have one mother structure on all that?
I did have, yeah, like a, top level LLC that didn't own any real estate directly. And then I had some like single member LLCs just to have a little bit of kind of risk diversification. At first I was going to do each one in a different LLC, but when you're looking at duplexes, they're just not that expensive. So I ended up using maybe 2 different LLCs to acquire the rental properties in. But then when we institutionalized it, they call them like SPEs or special purpose entities. So each each piece of real estate had its own LLC that was then owned by the fund LLC, which is where the investors put their money.
What made you decide at that point in time to pursue that fork in the road as opposed to continuing to build your own portfolio through what had been working, which is what many weekend warriors do, right? Building your own that way and wake up one day with a big portfolio. But you decided to take the other route. What made you make that decision?
Well, yeah, probably a lot of different things. I mean, one is I didn't want to continue working in banking or finance, and I wanted to do something more entrepreneurial, more self-employed. And then also, as you know, being an entrepreneur, you're always looking to say, "Hey, I've done something good. How can I improve on it?" So I've been able to build up my own real estate portfolio. Well, how can I do that better? I can bring in money from other people. We can have a bigger, more diversified portfolio. So it was, both trying to improve on my craft, so to speak, but also do something full time that I really enjoyed because I really do enjoy real estate. I used to say real estate's my job and my hobby. The job was with the institutional and the investor type stuff, and the hobby was the stuff I did on the side on my own, and make a career change essentially.
So you professionalized what you were doing is this is now my going to be my business as opposed to my asset growth vehicle. So if we put Taylor back in that position, that frame, because there's a lot of those Taylors around there, right? We've got 5, 10 properties, and we've done a good job. And I'm sure you kind of thought of other options, and the things I want to kind of go over briefly with you for somebody in that point in their career. We could put some of these things in self-directed. We can go into, okay, we're going to get our license. So it's active management and all those kind of things. First, can you walk through a little bit for somebody that maybe isn't familiar with the active versus passive management element of owning real estate, how that breaks down? And then I want to come back in and talk a little bit about putting in a self-directed IRA.
Yeah. So the active versus passive, you just mean kind of operationally, how is it different, or tax code?
Tax, how, what we need to do to qualify and the tax implications of doing that. Because that's another fork that many people find themselves at as they're going through this journey together.
Yes. So there's something within the IRS tax code that is, I believe the term is real estate professional. So if you qualify to be a real estate professional and make that election, you are able to use losses from real estate to offset other income. So if you have W-2 type income, or you have earned income from a business, you can also use the real estate losses, which there's ways to accelerate and maximize those losses to offset your income. So that's why if you talk to a lot of real estate guys, sometimes, their taxable income is zero or very low, or it fluctuates a lot, because when they acquire a property, they can accelerate the depreciation and offset all their income. In order to do that, it's a 3-pronged test. And I have a pamphlet I can send you too, if you want to distribute it, as to what that looks like. But you have to spend more of your working time in real estate than doing something else. So essentially, real estate needs to be your primary, like, professional or earning activity. And you have to spend, I believe it's a minimum of 750 hours working in real estate. And then you have to be active, which basically means you're in the management of this real estate in some fashion. And that one's pretty simple. You can attend a quarterly meeting. If you have some property managers or someone like me running it for you, as long as you're on the board, so to speak, and, come to regular meetings, that's considered active. So you have to be active. You have to do more real estate than you do other things, and spend a minimum of 750 hours in real estate. And the way I have a lot of clients qualify for this, like, if a client is a doctor or something, they're making a high income, they don't want to give that up, but their spouse doesn't work, their spouse can qualify if they file joint. So, the doctor works, makes a high income, high tax, the wife does the real estate activities to meet that qualification, then they buy the real estate, use accelerated depreciation methods, and can eliminate the tax that he earns, as a doctor through his salary or practice.
So that's how investing in real estate can really be used as an income tax management tool. Then we have the side effect, unfortunately, that of recapture and all that kind of stuff that can be a challenge. So let's now flip for a second to putting it into a self-directed IRA and using it as an asset building tool instead of getting those income deductions.
Yeah. And I will say, there are ways to eliminate the recapture as well. And that's a lot of that's through estate planning. But on the self-directed is another great strategy. I use that a lot. But essentially, you need to find an IRA custodian who allows for true self-direction. So some will say we let you do self-directed, which just means they let you pick stocks. You need to have one that lets you purchase assets besides stocks and bonds. So you can have, purchase gold, art, racehorses, famously, I think Mitt Romney did, and real estate, of course. And so with that, you just transfer your money that may already be in an IRA to the proper custodian. And then the IRA is the purchaser and owner of the real estate. So then you get all the IRA tax benefits, and you are able to invest in real estate and get those tax benefits.
Have you found that, just a couple more questions here. We could talk all day about this, but have you found that banks is there financing so that you can bring that leverage element if it's inside of a self-directed IRA?
That gets a little bit more complicated. It is doable. There's a lot more rules. And one of the key rules is you can't personally guarantee it. And so you can get what's called non-recourse debt where you don't personally guarantee, or what a lot of my investors do is they'll invest in one of my investment funds where I'm personally guaranteeing everything. So they'll take money from their IRA, invest in my project, and then they've got the real estate ownership uh, without having to worry about hitting that personal guarantee that can eliminate some of the tax benefits.
And then, so that is a path into diversifying through real estate, that they could go to a fund like yours, put $100,000 into the fund. And when that fund grows to 50 or 150, $200,000, then that fund could be sold to buy real estate within that self-directed wrapper. And we don't have any recapture issues or anything like that they need to worry about.
Yeah, you get the same tax treatments or you get the tax benefits of the IRA. So, which depending on if it's a Roth or a traditional, they're different, but essentially it's not taxed.
And then one more fine point on this before we kind of give it a wrap here. In that environment, one of the challenges that I see from a structural level as a financial advisor is liquidity and all that. And especially if you got RMD calculations, those kind of things that come off of having it in a self-directed IRA. But with what you've just described there, then there are other mechanisms outside. So let's say you've got $500,000, $1 million in a rental property in your self-directed IRA, that you don't want to go through the rigmarole of valuing every year for RMD or whatever. Now because it's in that fund within your IRA, then it can be moved into one of your structured funds or something like that. And then we have cash flow potentially, we have valuation metrics taking place, all those kind of things, so that you're able to comply with the rules of the IRA and RMDs. Am I tracking that?
That's right. Yeah. So my investors who are at the point where they have RMDs, which is required minimum distributions for their IRAs, they usually have other assets in there like stocks and bonds, things that are more liquid. So that's how they're going to do their distributions, their RMDs mostly. But typically we're paying, monthly or quarterly cash distributions as well. So that can be kind of part of their calculation. But as you well know, RMDs, it takes some planning to make sure you get that done correctly.
So RJ, before I ask Taylor to give everybody how to get a hold of him and let him sign off, you have any questions that are rolling around in the back of your head as you're listening to our conversation?
No, but it's a ton of great information. That's for sure. So, real estate is always something that I've always found interesting, and have dabbled in a little bit in it periodically throughout my career. But Taylor covered a lot of information there.
Taylor, I would like, if you would, send us that document you mentioned. We'll have RJ's team put in the show notes. And if you could, if people wanted to talk to you about just real estate investing in general, or your funds, or any of that stuff, how do you like for people to get a hold of you?
Sure. Yeah. Happy to speak to anyone kind of about anything. As you can tell, I can talk about real estate forever. The people I help most are those clients who have a lot of real estate and they're thinking about multi-generational planning with it, especially on the tax side. Like I said, there are methods for eliminating that depreciation recapture tax. And then also with businesses, how they can take their real estate, especially that intercompany leases, things like that, and eliminate income taxes. So it's really those families and those companies with real estate that I help the most. Best way to get a hold of me is you can email me, which is just my name, Taylor, and my company website at Blue Ridge AM. So AM for asset management, Taylor at blueridgeam.com. Or you can call me, my cell phone, or text me even. Text is even better. Call or text. Cell phone number is 864-915-8719.
Taylor, thanks for your time today.
Before you go, Greg, how about your contact info?
Oh, people might want to get a hold of me. Yeah, sure. If you want to get a hold of me, best way is to get into my ecosystem at www.gsdupont.com, and you can branch out from there.
Excellent. And if you've not subscribed to the March to a Million podcast, make sure you do that. If you know of an estate planning attorney, financial advisor, or a client who really needs this information, please make sure you share this podcast with them. So for Greg DuPont, I'm RJ Malik, and we'll see you on the other side of the mic very soon.